Hello, hello. Welcome to Woody's Weekly Wisdom, episode number 14 already. And what a incredible headline, just move myself out of the way, incredible headline I've got for you today. And this is something that's actually been coming up in a number of conversations in the last week with clients, which is really pleasing that people are aware. But it is another great example of why I do these weekly wisdom episodes, because here we have it. The headline, worst case outcomes revealed as fears over US debt ceiling ex-date explode. So again, lots of fear mongering in those words and in that headline, and designed obviously to get us to click, which I've done, so they've won. And really, again, a classic example of what's a potential outcome from a fear-based article like this one. Now, the reason I want to talk about this one in particular is that it's not the first time, even recently, that the US has faced the possibility of defaulting because of its debt ceiling. It's happened a few times in the last few years, and we'll see shortly on when the last time it happened and what happened as a result of that. So I'll talk a little bit about that. But the thing is that these are very much political motivated debates, and it's a case of who blinks first, because both parties know, pardon me, both parties in the US know, political parties know in the US, that being blamed for the default is potentially catastrophic for their economic credentials and at future elections. So nobody wants to be the one to be blamed for why the default occurred. Now, that's not to say that a default may or may not occur, or may occur, but it's predominantly just a reflection of the fact that this is very, very much a political battle at the moment to see who has the biggest kahunas and who can walk away from the negotiations claiming victory. And the broader impact on the economy in the US and therefore the world is almost irrelevant to the people in this negotiation. All they're worried about is who can walk away and say they won the negotiations and therefore they're better at managing the economy, or they're better at whatever they want to say that they're better at as a result of this debate. And as I said, the risk of a default has happened many times in the last few years, and they've always resolved it and prevented it from happening. But we will see when the last time it happened. As we scroll through the article, you'll see what happened the last time it occurred, which I want to talk a little bit about, because I literally just got off a call with somebody who was very fearful of potentially the stock market crashing as a result, and there's a fearful word, crashing, potentially crashing as a result of this, I guess, political bun fight over in the US. So let's just have a quick look through the article. We'll try and skip as many of these ads as we can. So the experts are growing increasingly frantic amid fears that America could default. And basically, this is all about the fact that the US has this debt ceiling which prevents it from borrowing more money to pay its bills. And if it can't pay its bills, it means government has to shut down because they can't pay their employees, and that leads to a whole host of follow-on or flow-on impacts. And you've got the Democrats and the Republicans who are battling over what is the right position to take at this time and in these times. And so that's what's going on. Janet Yellen, who has warned that it could, default could occur as soon as June 1, so just 16 days away. So it is, it's a political hot potato at the moment, and it's certainly going to attract a lot of attention over the next 16 days until something is resolved. And this is, given that we are leading into an election year next year in the US, this is a particularly, pointed debate at the moment and negotiation, because it's extremely important for both parties to come out on top in this one. And so it's a higher risk of default or a decision not being made or an agreement not being made and therefore default occurring. So that is why I guess the headlines are a little more fearful than they were maybe 12 months ago when this happened. But yeah, we'll just keep scrolling and see. We'll try and get rid of that. So you've got all the experts are tipping in on what are the, here we have the 7 doomsday scenarios that could play out if America were to miss the date. And let me scroll down. Here we are. So the stock market turmoil with one of the first major casualties of a default. So this is where we're interested because we're growing our wealth by using stocks. And they're saying that last time this happened back in 2011. So that was when the last default happened 12 years ago. And the stock markets fell 20%. Now that's pretty bad, pretty fearful. But there's two comments I want to make about that. One is if you were to have a look at the stock market charts and have a look at the trajectory of the charts over the last 100 years, there's lots of times when the stock market has corrected by 20%. And then it just comes back over a period of time. So for the thing about, say, a stock market crash of 20% is that it's just going to promote opportunities. Now, we may not be jumping in and buying stocks the next day after that crash because we want to see a little bit about what goes on, who might be in trouble as a result of lack of access to cash and things like that. So we'd observe for a little while and then we would be unloading and putting as much money in as the market recovers, which it's going to do. It always does. So this is where the fear gets a little bit out of control because this is going to be a short-term impact. What's going to happen is they might default. They'll then come to some arrangement and markets will go back to normality. And that 20% correction will just weed itself out again. And markets, they might not do it straight away. They might not do it as quickly as they fall. But it just then presents opportunity for the smart investors to jump in and take advantage of this crazy scenario. So that's the first real major point that I want to make about this fear about the stock market crashing. We should just see that as opportunity. Now, it's an unfortunate opportunity because a lot of people will suffer if they default. Like I said, a lot of government employees won't get paid, so they'll be stood down and won't be getting paid. So that is painful for a lot of people, but as investors, we also have to be mindful of the opportunities that it creates for us. So we'd have a look at that. I'm just going to move me around a bit and just get out of the way and try and get some better light. So the stock market has crumbled or crashed in the past, and there it is. 4.2 million government workers would be left in limbo. So that's a really, that's a sad scenario. You then got Medicare payments. A lot of these things obviously occurring in the US. So if you're not in the US, it has a lot less impact. But the next one that is of interest to everyone around the world is that it's a possibility that a default could push the US into a recession. And if that occurs, then it's almost a given that Australia will go into recession. We're very closely tied with what happens in the US. So that's a big impact here in Australia as well. So we're interested in what happens, and a recession, depending on how long it lasts, is less of an opportunity for stock markets. It will mean that there's a prolonged period where the market won't go anywhere. So there's no need to rush into the stock market, but we'd continue to pick up good stocks at good prices, whilst the prices are let's call it deflated a little, knowing full well that as the markets return to normal, that the pricing will return to normal and continue to grow as well. So there's some issues there in terms of what might happen in terms of recession. And then this part of the article is less important in terms of what we do as investors, but it's talking about the harm that these negotiations will have in terms of the political framework in the US and the standing of the US to the rest of the world, where politicians have allowed their egos and their want for power to outweigh the impact of their decisions on the rest of the country and the world. So that's a fairly sobering thing to think about. And Janet Yellen is trying to be the voice of reason there by saying this should not be about winning political battles, but more about making sure that the country can continue to operate as per normal, and that they can resolve these other issues about spending and spending cuts and all that type of stuff in other ways, without having to use this debt ceiling as a bit of as a hand grenade as such. So there's that stuff going on. And there you go, $88 billion to stop global disaster. So they're down to a small amount of money, $88 billion, to pay their bills. Seems like a lot to us, but when you're running a country, it's not a whole lot of money. So they're talking about each quarter they go through $333 billion. So it is time that some action was taken, and that they got out of each other's way, and they got on with allowing the country to operate as per normal. So there's some points, but if I pause on this graph and highlight, you've got these falls happening here. That's a great example of what could happen. And then if we go into a recession, that's what could happen. It could go a little bit sideways for a while, but then that's another good example of what ultimately will happen, and that is that the markets will return to some form of normality, and stock prices will climb back to where they were and continue to go on. So be very mindful again of headlines like these. Understand, and this is what we're trying to do with these Woody's Weekly Wisdoms, is to give you the story behind the story. And as investors and people looking to grow their wealth, we want to make sure that we're not allowing these headlines and short-term matters impact our long-term thinking. We're entering the stock market with the understanding that we're never going to sell these stocks because we're picking good stocks. Now, we might have to at some point because something will happen or things can change. But our expectation when we go into buying stocks in the market is that we're going to hold them for a long, long time. And so things like this are going to happen all the time. We're going to have ups and downs along the way, but ultimately we're buying good quality stocks that in the long term, 10, 15, 20 years time, are going to be worth a lot more in that time frame than what they are today. And any correction of 20% because of something like this, which would be short term, or even if it goes for months until they resolve it, it will eventually be resolved, and the stock markets will return to normal. So it's opportunity as well, and it's a time to be less, I guess, fearful and a little bit more attentive, but certainly not avoiding the stock market just because a couple of political parties are having a battle over in the US. So I hope that's helpful. Leave me a comment down below. If you want to have a conversation about how we can help you grow your wealth and give you the education to do that on your own, then reach out, send us a message, leave me a message in the comments. However you would like us to get in touch with you, or you'd like to get in touch with us so we can get in touch with you, do that so that we can line up a chat. It's a no obligation chat. There's nothing to buy on our first chat. It's more a case of finding out whether or not we can help you, and if we think we can, then we'll talk about ways we can do that for you, and we'd love to have a chat. So that's Woody's Weekly Wisdom, episode number 14. I look forward to next week's episode, and hopefully we'll have some more updates on what's happening in this scenario, and we'll see where the world is heading in 7 days' time. Have a great week. See you again next week. Cheers.